Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McClain, thanks for joining us.
We talk about financial stuff. What, do we need to put the intro every time? You know, I figure.
Okay.
Huh?
I'm not changing.
We've been doing it this way for 29 years.
I'm not
Doggone it. It was good enough for yesterday.
I'm not changing.
Yeah, don't change now.
Dang it.
Don't change now.
Oh, I went to the gym this week. Oh, I hate this time of year.
What do you mean?
The parking lot was packed. There were people everywhere. I'm like, why don't you guys just give up already?
Oh, nice. That's a good way to love your neighbor.
Oh, no. It just reminded me. Like 4 years ago, I remember the gym. These two guys I knew from church, they see me in the gym, and they're like, oh, New Year's resolution, Pat, working out. And I'm like, no, you're the new guy here. I've been here. You're the new one. Now, quit already.
All right. Well, good. We got that out.
I'm angry.
Anyway, we got a good programmer here. By the way, before we start, we looked at some stats. We've been doing this program for almost 30 years on the radio, primarily for decades, and then now podcasts. And we just last year hit our 3 millionth download.
Wow, wake the kids, call the neighbors.
According to Buzzsprout, we are the top 1% of all podcasts for downloads. And according to Listen Notes, we're the top 0.5% for popularity out of 3.5 million.
And I
podcasts.
saw my income go nowhere because of this. I didn't get a raise. How's this benefiting me, Scott?
This is supposed to be for the listeners, the 100,000 engaged listeners.
I'm relatively coin-fed, okay? So I'm going to ask for a raise.
Why don't you do that? Ask for a raise.
Who do
you ask?
Who do I ask?
I don't know who you could ask. You're the founder of the firm.
I know, it sounded like the right thing to say. But now that I think about it, okay, well, that's nice. 0.5%.
Look, I understand that anybody can start a podcast out of bed.
There's probably millions.
There's 3.5 million globally, according to Listen Notes.
Globally.
There's probably more than that, though. They don't even know how to get on the platforms.
Right? There's yeah.
There's so many podcasts.
There's so many podcasts. Oh, there's so many.
But anyway, glad you're listening to this
and
podcast.
What's your favorite podcast?
Well, let's get to that. It's irrelevant.
No, it's not.
I don't have a favorite. They tend to bounce around.
Okay.
I listen to, honestly, almost typically the same day it comes out.
Do you?
I like that.
And that's with
Barry Weiss, Free Press.
I've listened to that a couple times.
And I've been listening to Built to Sell.
I love that.
About companies that sold founders that sell the business.
And it's kind of like how I built that. It's very similar.
The opposite. Yeah. How I sold that. Yeah.
Anyway, let's go.
Yeah.
So, all right, and by the way, just remind me. So I wanted to come back to this about these. You talk about podcasts in the world, 3.5 million. They're doing the same thing with exchange traded funds.
There's so many of them.
There's so many of them. There's so many of them now. Right? And 5 years ago, there were almost none. But now they're like every flavor. One that just tracks NVIDIA
and
stock.
they're not necessarily good or bad. It's dependent on how they're used, like most financial tools.
That is right. So I'm going to talk a little bit about the proliferation of exchange-traded funds. And it always reminds me of, I met this guy at a conference, years ago. This old grizzly veteran of the financial services industry. And he said, Pat, remember, when the ducks quack, feed them. And I'm like, what does that mean? He goes, if the clients want something, you give it to them, regardless whether it's good for them or not.
Was he serious?
He was 100% serious. And he sounded just like that. I'm like, what? He goes, when the ducks quack, feed them. Which was, if the clients are asking for something, if it's good for them or not, you give it to them because you can make money on it. And when I read this article about exchange traded funds, I thought exactly of this grizzly old.
And we'll talk about those.
And we'll talk. Please don't
No, we won't forget.
Don't forget,
All
please.
right. I'm looking forward to it. Now don't know if I can concentrate because can't wait for this conversation.
Now you're making fun of me.
All right, let's take some calls.
It's not hard.
It is not hard. If you want to be a part of the program, you've got a question for us. And we love taking calls on just about anything financially related, particularly those that have saved well and are looking at how to maximize what they've got, both for themselves and for others. So you can send us an email at questions@moneymatters.com, and we'll get you scheduled to be on the program. Or you can call 833-99-WORTH, and we'll schedule you to get on the program. We're going to start off here in New Hampshire with George. George, you're with Allworth's Money Matters.
Hey, guys. How you doing?
We're great. Very good, yeah.
Yeah, good to hear that you guys finally made it to the gym this year.
Oh, now you're piling on? I tried yoga, too, by the way, but we're not going to get into my physical. What can we do for you?
Anyway, yes, my question is more for my ex-brother-in-law instead of myself. My ex-brother-in-law, he is 60. He's never married. He has no children. He smart guy, has a really good job in accounting. 10 or so years ago, his parents passed away, and he lives in his parents' house, which he co-owns with his 3 siblings. He also bought a house of his own about 15 years ago. It's now worth $500,000, and he has 50% equity in it.
Okay.
He rents that out for about $2,000 a month.
Okay.
And the big question comes is that he would like to take that house that he bought, sell it, and convert it to Bitcoin. And I've kind of talked to him a little bit, because Bitcoin is very volatile, obviously very speculative. And, the thinking being that, as you get older, you probably don't want such a high percentage of your portfolio into something that risky, right? But his side of the story, right, is that Bitcoin has doubled every year for the past 4 years.
Okay.
Which may be true, right? That may be true.
Well, it wasn't a straight line, but keep going.
Yes, yeah, exactly. Like if you look back on history, right, there's a lot of things like, tulips and Beanie Babies had a good couple of years
That's
as well
exactly
back
right.
in the day.
And I'm sure there's other assets that are up 100x over that period of time as well.
Brilliant.
But yes,
Okay.
it's a popular one, and it's a big one.
And what did you tell him to do? Well, first of all, did he come to you for advice, or did he just tell you he was doing this?
No, he didn't come to me for advice. No, he is something I just happened to find out and try to, it's one of those things where try to talk him out of it, but, Bitcoin could go up 20x, and then I'm on the hot seat. Yeah.
I'm asking this seriously. Are there any other, like, mental issues? Truly, what would cause someone to actually act in this manner? No sane 60-year-old
is going to take that big of, I don't know what he has in savings, but does he have a lot in other assets?
Like, is this,
if he had $10 million sitting in other assets,
you'd be like, go for it. Yeah, it's 2.5% of the portfolio.
I'm sick of dealing with this rental. I'm going to take my $250,000 out of that, and I want to buy Bitcoin. Fine. If you had $10 million,
if you have $1 million,
then it's insane.
Yeah. Okay. Yes. That was kind of my point of view. I think you should, especially, at any age, you should diversify, but especially as you get closer to retirement, right?
Yeah. And as a percentage of the portfolio. Scott and I were just talking before the show about bad investments we have made. We were.
Yes.
Right.
We were.
That we have made. Right.
Yeah. And then not everything works out.
No, and then we reminded ourselves, but many,
almost all,
great investments, but. Right? Because, in fact, we're human with our own emotions. We have a tendency to dwell on the losses. What percentage of your portfolio do you think this is? Is it little or big to him? Or
I would say it's I don't know, but I would say it's at least, 20, 30% if I had to guess, but I don't really know.
What if we gave you the right answer, what would you do with it?
Oh, I'm going to, send him this podcast so he can hear.
Okay. Well, it's crazy. It makes no sense.
It's pure speculation.
Why? Why Bitcoin? What's wrong with NVIDIA?
What about Dogecoin?
Oh yeah, Doge. Why are we stopping at Bitcoin?
Yeah, exactly. Like if you were to take the even the volatility of Bitcoin out of it, I think if you were to put, as a 60-year-old, if you were to put a large percentage of your portfolio on any one stock,
That would be foolish
your
too.
retirement quality of life is going to be completely tethered to that one investment.
George, if he was my relative and he shared this with me, I would say to him, "You're out of your mind. That's just stupid." And then I would leave the conversation there.
And you can't live with me.
That's fair enough. And I would leave the
and I'll say I have had that conversations with many people. They want to do something that's like, look, if it doesn't work out, if that's what you want to do, if you want to follow it, if instead of taking my advice, if you want to do that, that's fine. Just remember, you can't live with me.
We have fired clients over
absolutely.
They're telling us they're going to do something, and I'm like,
what's
I'm
the
not going to
point?
be party to this.
No, because you know how it's going to end up.
I'm not, and maybe it ends up great. Maybe he's 100% right. Maybe he is the most brilliant guy in the room, and it goes up by tenfold. And now his $250,000 would be less than 250 after taxes. It's probably 200,000. It turns into $2 million. Is his life better? Is he happier?
What if it goes to zero?
But what if it goes to zero? What do you tell that story? Tell the story about the guy with the fishing boat.
Yeah.
I love that story.
I love it too. That's why I've told you. This was in the .com era.
So 98?
Probably 99, maybe early 2000s.
Okay.
And a client called me up and he says, Scott, I'm thinking about taking half my portfolio and putting it in the cubes. Right? That was
What's
the
the
NASDAQ.
QQQ?
All tech. This was it had a huge run up, just like your ex brother-in-law saying, "Here's how great it's done the last 4 years." NASDAQ had been on fire; it was up 85% in the year 1999, and so I said, "Let's call him Bill." I said, "Bill," and Bill had a house in Northern California, and he had a house up in on the coast in Washington.
I thought it was in Alaska.
I changed this to the.
It was Alaska. It was Homer.
I'm trying to keep a little anonymity here.
Okay.
So let's say it's not Homer.
I'm not helping.
I'm trying to change a little of the facts here. I should have changed Bill's name to something different while I was at it. No, I didn't. So
his name was Frederico.
So he spent the majority of his time in his cabin on the water, out in his fishing. He fished all the time. He loved it. He had a fishing boat. And he called, he wanted to make this move, and he says, what do you think about it? And I said, well.
Half of his portfolio, all tech.
Half of his portfolio.
And he was living
all
off.
tech stocks.
Yeah, and he was living off the portfolio.
Correct. He was retired. And I said, well, here's the thing, Bill. I said, if you're right, we can trade in that fishing boat for a bigger fishing boat with more electronics and all the goodies on it. But if we're wrong, the fishing boat's gone and probably the cabin as well.
All right. So that you did.
So I framed it back to what this is not just numbers on a spread on a statement, right?
This is life.
This is how
lifestyle.
It translates.
Yeah, no one's going to starve in America unless you're mentally ill or have no access to it. But it's lifestyle.
What do these dollars actually mean? And so the concern that you have, George, obviously that we have with this 60-year-old male, that if he probably doesn't have much in savings and he takes his one asset he does have and puts it in Bitcoin.
Yes.
I would just tell him you can't live with me.
Yeah, and it's your ex-brother-in-law, which I think is interesting in and of itself. Yeah, I mean, it's asinine.
I think people.
Am I allowed to say that? Yes. It's crazy.
It's all about probabilities of outcome. And particularly as we get older, we don't have the time to make it back up.
Yeah, if he was 30, I'd go for it.
Whatever. It's not going to make it.
And again, you can't live with me.
But it's coming back to like what happens in the best case scenarios, but what are the worst case scenarios here? Like when we do financial plans with people, we look at what happens if the day after you retire, we go through another financial crisis.
So probabilities of success or failure.
Correct. And most people are much more concerned about maintaining their lifestyle than they are about becoming wealthier. And if you do something that's suddenly going to have a 60% chance that your lifestyle is going to go backwards, most people are like, I'm not going to take that.
That's right. Unless right? And it all gets down to what percentage of his portfolio is this. But you're right. You know exactly. And you're going to send him this podcast?
Oh, yes.
That's all we need is another negative review. All righty.
Appreciate the call,
Appreciate
George.
All right. Thanks, guys.
Yeah,
All right.
is,
So, Scott, you talk about you can't live with me. So, many of the listeners know I have 4 children. They were home for Christmas. And my wife and my only daughter were going to each one of the kids' bedrooms, and they want to redecorate them for some reason. I'm like,
redecorate it how?
that's what I said.
Who wants to redecorate it?
My wife and my daughter are like, we're going to move some furniture out of this thing and repaint the walls and the whole bit. I go, what? The kids are gone. They only come home for like a week a year.
Does it still look like they live there?
Yes.
Oh, come on. I can understand your wife.
Really?
Yes.
I just shut the door. It's fine. The door. It's closed. It doesn't have anything to do with it. So, the end of the story. So, there's this kind of a futon thing in my son's room. It's like this. I don't know what it is. Starts with a P or whatever. So my wife. It's a chair. It's a chair thing, right? So my wife actually, she says, "Okay, can you help move this thing out in the garage and then get rid of it?" And so I said to my daughter, I go, I'm going to get rid of it. I'm going to put it on Facebook and just send it out like, here, cheers, come into my house and pick it up. So we took pictures of it, and me sitting in it, I was modeling for it, which just created a whole new list of just people making fun of me on the internet. But my son responds, "Oh, this is a great way to find out you're changing my room." He saw that we're giving away his furniture from his bedroom, and he responded on Facebook, "What happened? Why are you doing this to me?" My room.
How old's your son?
23 or 24.
So I had a good friend of mine. I'm going to give his real name. There's no anonymity in this one. Mark Holloway. His dad passed away, and I went down to San Diego to go to his funeral. And so I went and I saw the family home.
Okay.
Mark is 60.
Okay. All right. I know where this
The room he shared with his brother had not changed since they went off to college.
Little League trophies?
I kid you not. The trophies, ribbons from the track. I laughed so hard. I got such a kick out of it. The room, it was like a museum from his teenage years. Had not changed.
What's wrong with that?
Well, I guess his mom didn't have any problem with it. She enjoyed it, apparently. Yeah. She would probably go in there from time to time and think about the good old days.
Were they?
I guess. If they were bad, she would have. Maybe that's why I've changed my kids' rooms. The day they leave, remodel, repaint.
That's like they're out. They're in the car driving away. You're waving. You run back in the house. You start stripping the room.
We're going to go back to culture in a minute. I remember when my oldest daughter was in high school.
This is a financial show, though.
My oldest daughter, when she was in high school, she wanted to paint her bedroom.
Okay.
And she was like 15 or 16.
The young Jessica.
She was young then. Yeah, she was 15 or 16. So I thought, be a nice thing for father-daughter time together.
Oh, to paint?
Yeah.
What's wrong with you?
Her ceiling had a little different shape to it than it wasn't flat. So there's corners and stuff. We spent like 3 days, maybe not full days, but 3 days painting. When she moved out, I'm like, I got to change this thing because it's looked horrible. And I hired a painter. He blew the thing out in like 3 hours. I'm like, I had to hire a painter the first time because I couldn't get the lines good enough. I get someone to come make it look decent. Anyway.
All right, let's go to the
life stories.
Oh my gosh, that actually. Well, it's nice seeing you again, Scott. We haven't talked in a couple of weeks. It's really kind of fun. Kind of miss it a little bit. I'm not enough that we're gonna actually start spending time together. So Scott and I stepped down as CEOs. We don't really interact much.
No, we don't interact much anymore.
Yeah, we used to talk twice a day.
Oh, oftentimes I get a call from Pat at like 7:01 in the morning.
You told me not to call before 7.
So I could tell, Pat's been awake since 3:30 and mulling on something. There's something in the business that's been bugging him.
Oh, my gosh. I don't miss that
3:30 in the morning. All right, let's go back to culture.
I don't miss it even a little.
Now you're just doing the stuff you like to do.
That's right. 100%. I go out to lunch with clients now. I've never gone to lunch with clients in my whole career. I go out to lunch with clients. We're not in a hurry to go anywhere. They're retired. I still kind of have a job.
When do you need to be back at the office, Pat? No rush.
I don't even pretend.
What, you want a dessert? I heard the flan's good.
Oh, listen, it's Tuesday. You know, movies are half price.
All right. We're going to start. I talked at the beginning of the program about these engaged listeners. That's all changed now. The numbers are going down.
Oh, look. We obviously have decided it's just about us.
All right. We're in Ohio talking with Scott. Scott, you're with Allworth's Money Matters.
Yeah, hi Scott. Hi Pat.
Hi.
Hi.
I want to let you two know that I am an avid listener of your Saturday morning podcast for many years, and during that time, I have managed to pick up a few financial nuggets along the way. So I thank the two of you for that.
Thank you.
Thank you. Probably a mistake, but
It's been very helpful.
what can we do to help today?
Okay, so I'm a firm believer of the Roth IRA, the Roth accounts, whether it be through my company initially, Roth 401k, to now in retirement, my Roth IRA. And during the last few years, I've done Roth conversions. I've contributed to my Roth IRA accounts, and the 5-year rule gets thrown in my face all the time. So what I'm wanting to ask you,
When you say that it gets thrown in your face, other people tell you about the 5-year rule?
well, yeah, they tell me about the 5-year rule, what that consists of. So my question does center around the 5-year rule item.
Okay.
So,
And then I'm going to tell you why it doesn't pertain to you. But go ahead.
Yes.
okay, well, hopefully not. So the 5-year rule, I know it only pertains to earnings and not what I contribute. So who keeps track of when the 5-year rule ends?
Nobody.
That's brilliant. That is the best question we've had in a long time.
Nobody.
No one.
Well, I've asked that question of many financial, and I never get a response. I never get an answer.
Look, a lot of the tax code is voluntary compliance.
That's right.
A lot of the tax code, 529 plans, right? Have you ever seen anyone audited on a
Never.
520 plan? Have you ever seen anyone audited on a Roth 5-year?
No,
row?
never.
Never.
Well, then it's very rare someone takes money out within that 5 years.
That's right.
Particularly someone who really loves Roth, a firm believer in the Roth.
which is the last dollar to be spent. But your question is actually, it's a brilliant question.
Because there are some laws that get passed, regulations that require financial companies to do certain things.
Reporting of income.
Reporting of income, how much dividends and what transactions occurred in your account last year.
So
And required minimum distributions. What is the required minimum distribution?
But none that are required on a Roth.
Really? I thought they were required as going through a financial institution. They were required at the end of the year to provide a form telling you what you have contributed to your Roth IRA.
That's right.
Or traditional IRA.
But there's nothing to say that when was the first account opened? When was the first Roth contribution made? There's no requirement.
There's no
of that.
requirement for that to the financial.
Otherwise, yours
institution to
might say,
report that.
first contribution made in 2006.
Yes. So when I convert from a traditional IRA, maybe in stocks, and go over to my Roth IRA, keep it in stocks, and I sell the stocks, my Roth IRA, and do something else, I lose track of what I'm doing. So you're telling me I don't have to worry about the 5-year rule?
Have
No.
you
taken money out of the Roths?
I have not. No,
Okay.
I don't plan on taking money out of the Roth for many, many years.
Okay.
So it'll be more than 5 years since the time you made your first contribution or the time you made your first rollover. Conversion.
Okay, so it's really not applicable to me, but it could be applicable to somebody else.
But the reality is, normally when people use Roths, they use it to feather income.
They're voluntarily
tax-
paying additional taxes today that they don't have to pay, right?
Right.
Because they could have made a pre-tax contribution or they didn't have to do the conversion. So these are people that are planning their finances, stating to the IRS, look, I'm going to send you money today in exchange for the promise that Congress made that let's hope they're going to be good on that promise when I pull my money out 20 or 30 years down the road.
Right. So your point is well taken, but it doesn't happen in reality. When you see people take money out of a Roth, what they're doing is they're trying to keep they need X income, and they're trying to keep themselves below a marginal tax bracket. But the reality is most of the people that have money in Roths also have money in a brokerage account.
Of course.
Right?
Absolutely.
So
yeah.
I can't. I'm
There's other
trying to
monies.
think of when I've had money come out of a client's Roth account. I cannot. Can you?
I had someone do it against my recommendation.
Oh, I can't.
And by the way, you mentioned sometimes we fire clients. That's when I fired. Yeah, I think about it. I think I fired 3 clients in my career. That was one of them.
Because they're not taking. They're doing harmful stuff to themselves.
What's the point? I don't need. I don't need you. I mean,
Well, don't say that. We like clients.
I love clients.
Okay.
I don't love clients that don't take my advice. That do things contrary to my advice.
That are going to be harmful.
What's the
to
point?
themselves,
Why don't use me? I mean,
but yeah. So your point is well taken. But it doesn't. It's not real. It just doesn't happen. I wouldn't.
you don't have to. You Scott, you're like.
So if I were to ask an IRS agent, he'd tell me something differently then, right?
Why would you be talking to an IRS agent?
No, I won't. No, I don't. No,
He might not even know what you're talking about.
Yeah.
Well, maybe so. No,
I mean, out of all the things that they look for tax compliance, that's because it generates. By the way, what's the point of it? I mean,
yes.
They would just assume you pull money back out of your Roth and put it in a taxable somewhere else.
yeah, but
I would think so.
But what's the point? Think about this, Scott. What's the point of it? What's the point of the 5-year rule? Think about. I never understood why it matters.
Yeah, it didn't make any sense to me.
I mean, I understand the 59.5.
Well, I don't understand why it's 59 and a half.
but I
Let's use a
understand
round number.
Older age.
Yes, you have to start withdrawing. And the required minimum distributions at age, 73, 74, 75.
That doesn't apply to Roth.
Yeah. Anyway, I'm just going to, Scott, let's find other things to think about.
Yeah. Is that Scott? You are a blessed man. If in your financial life, this is the one thing that you have to worry about.
Well,
Everything else is so great.
Okay? But
What was that? What did you say?
I do sleep well at night, so I'll just put the 5-year rule out in right field. Don't worry about that.
You're never going to have to. It's never going to be an issue.
And
for
do us a favor. Share this podcast with your friends, especially since you are one of the main attractions. You are the star of the show at this point. So
That's
if
right.
you could share it with your friend.
Well, my name's Scott, and of course we got Scott on the podcast too.
Yeah,
but,
but we're trying to.
If you meet anyone named Scott, it's always someone between age 50 and 68. How old are you, Scott?
I'm 70.
Oh, I missed it by 2
years. But I act like I'm 50, though.
Okay.
I act like I'm 50.
I got it.
All right, appreciate the call.
Yeah, thanks for calling, Scott.
Thank you, sir. Thank you, gentlemen. See ya.
I saw it on the Roth. The majority, roughly half Americans pay no income tax, right? Because you get a standard deduction.
Yes.
No income tax. So those people, if they're saving for money in their 401k or IRAs, it should clearly be in the Roth.
That's correct.
They're either in a 0% tax bracket or a very 10 or 12% tax bracket. It's only, I think, like 15 or 18% of taxpayers are in a tax rate higher than that 12%, that first bracket.
Say that number again.
It's like 18% of taxpayers.
So
half of the revenue comes from the 1%.
So that would be 60% of the population is below that bracket.
No, like 80%. 80% of Americans should be using a Roth 401k.
All right.
Like there's no questions even asked. Like just should be Roth.
But the reality is those people don't have any money and they don't have any money to save. They're living. It was like growing up. My mom used to say, "Oh, we should have bought that. We should have bought that property down the street, like 20 years ago." I'm like, with what? Where were you going to get this magical money that we were all of a sudden becoming land barons?
A couple of years ago, I was up in Tahoe, and there was this one area of Tahoe. These lots were sold there $300 a piece in like 1930 something. Okay. And someone said, "Why? Wouldn't it be good if the family?" I'm like, "Who had $300 in 1930? You're in those
rich people." Okay, so the point being, the Roths.
But if you're in a higher tax bracket, then you got to really look at it. Do you want to do a pre-tax or a post-tax? And if you're going to convert, how much do you convert?
And when?
And so it's the beginning of the year. I went on to my own 401k because the contribution limits increased this year to increase what's going in. And I do before tax. And I thought about doing Roth.
And?
I went before tax.
Because?
There's a chance federal income tax rates will go higher.
Okay.
Right? There's clearly that can happen.
And
I'm
interested in this.
There's also a chance that maybe there's a complete reform in taxes, and we now have a national sales tax with a lower flat tax rate. That's in the realm of possibilities.
Okay.
There's also a possibility I don't stay in California the rest of my life.
That's probably the biggest one. Do you really think that we'd go to a flat tax or a VAT tax?
And there's also, I'm probably not going to spend
some of it's going to go to charity.
Yes.
Right.
So with all those factors, I went, and I don't like the way California spends money, so I just assume take a pre-tax.
Why would you say that? They just laid 22 miles of the high-speed rail. They've been working on it
20 years, $100 billion.
22 miles. Come on, Scott, it's 22 miles. It's a long way, 22 miles.
$26 billion on homelessness.
Holy smokes. So back to that. The tax. Do you think that we would ever go to a flat tax? I just can't see it because it's not
politically.
It's not progressive. We have a very progressive tax system.
Right. That's why half of Americans don't pay any income tax. Now they'll pay payroll tax. They'll pay Social Security, of which they'll get a benefit from.
Yeah, but so if you went to a flat tax, would that not be considered a regressive tax?
Well, wouldn't be
a sales tax.
Right. It's by very nature. A sales tax would clearly be regressive.
Yes,
because higher income people don't consume all their
that's right
income.
Yes,
and to your point, if your mom's saying, "Oh, I wish we would have bought that property," there was nothing. I mean, there's barely like which bill do we pay this week?
Oh yeah, I always got a kick out of that. Never said anything though because I love my mom dearly. Didn't want to upset her, but I always thought, I grew up in this house. I don't think there was money splashing around.
It is clearly possible that tax rates are lower, and we have a national sales tax, value-added tax. I mean, the EU's got it. It's 17, 22% somewhere.
But they have a progressive tax rate as well.
Yeah, but not both. A lot of countries are lower than ours now.
All right. Well,
I think part of it, when you're considering things like Roth, and
you've got to take legislation into account. You have to recognize
what you're betting. You are betting that the tax code's not going to be dramatically different and that your withdrawals will be tax-free.
That's correct, right? So
it wasn't that when I started in this industry in 1990, there used to be an excise tax
on pensions, wasn't it?
On 401ks of greater than $750?
Yeah, there was a name for it.
It was a 15% excise tax.
Yeah, what was the name for it? There was a name for it. It was a tax code.
I remember numbers. I don't remember names. But there was an excise tax.
I remember this.
If you had a lump sum larger than,
yes,
I think it was $750, wasn't it?
Yes. Yeah,
there was an excise tax.
We were retiring.
So put that in today's dollars, that'd be like $2 million, $2.5 million. There was an excise tax.
Yeah, so the money would go into an IRA, but you still had to pay a tax on that transfer.
You paid an extra tax for doing a good job saving.
Yes.
So when even when you're looking at Roth conversion, some of those things like.
Yeah, just don't buy in 100%.
That's right. You want to diversify your tax strategy the same way you think about diversifying your investments.
Yeah. You know, I was talking to a friend the other day. It's like it just blows my mind that we get people to qualify for the Obamacare insurance that are worth millions and millions of dollars. These clients are worth millions and millions of dollars. And they get this
subsidized
health insurance because of how we negotiate through the maze.
That's because it's not based upon assets. It's based upon.
You just find that a little bit crazy?
There's lots of crazy things.
I don't know. I just find it and I participate in it. I'm helping them.
I had a conversation over the holidays with a family member that there was the discussion on lifting the cap for Social Security taxes on wages.
Okay.
Right. So, what is it, 170 grand a year, somewhere in there, where you pay Social Security taxes up to that point of your wages. Above that, there's no tax.
Yeah,
no,
and on both sides, and then Medicare goes unlimited on
Medicare
income.
goes unlimited. Yeah,
On earned income.
correct. On wage type income.
Yes.
Or self-employed income. And so I was talking to this person that they thought, well, it would seem to be fair there shouldn't be that cap on there.
Why? Well, that's what you said. Right.
Well, no, I said here's the challenge. When we've got the top tax rate at 37%, plus we've got the 3.8% excess tax,
I don't, whatever that, yeah.
which is 0.9% above the Medicare tax. So, so let's call it 40%. I'm a resident of California. The top rate there is 13.3. So now we're at 53%.
And you don't get to deduct state against federal anymore.
That's right. And so, you pay both sides. So the employer pays half, you pay half. So now
you're at 65%?
Right. So I said to him, the challenge with this,
65% at the marginal rate.
I saw, and the people who are having these tax problems are the ones, typically business owners that have been successful. They build businesses and this. I said, if we adopted this, what's going to happen is a business person can say, do I want to take the risk to grow my business?
It slows innovation.
Because someone's like, if I lose, no one's going to bail me out. It's all on me. I can't deduct a capital loss except
Against income.
Right. So I'm stuck. No one's going to bail me out of my capital loss. And if I do extremely well, they're only going to keep 35 cents on the dollar.
But you could carry that capital loss $3,000 a year forever. So you got that going for you. But you can't inherit it. You cannot inherit a capital loss.
Yeah,
it goes away at death. Right?
Yeah.
It's pretty disappointing.
Well, hopefully you don't have a lot of losses.
I don't. It's theoretical.
Yeah, I mean,
how did the argument?
I don't know. That was
and that was it. And you're like,
I said, get the hell out of my house.
Can you pass me the mashed potatoes? And what is that Jello thing?
It was a good conversation. It was just.
Are those marshmallows in the Jello?
You have those too.
Oh my God!
I'm kidding.
All right, let's go. Let's move.
Yeah. So. Right now we're gonna hear a client story from Victoria Bogner, and Victoria is our. What is Victoria? Vicky, welcome to the program.
Yeah, Vicky.
Hi.
Hi.
I'm the director of client experience.
Yes.
I know.
Director of client experience. Victoria's highly educated. In addition to being a certified financial planner, she's a chartered financial analyst, which is a very rigorous.
It's really hard.
Yeah.
And you work out of what office?
I work out of the Lawrence, Kansas office,
Which is
just west of Kansas City.
Thank
so
you.
It's all about the Chiefs right now.
That's, of course, it should be. Why would that be that as
and
well?
what's her name? The singer lady.
The singer
And Taylor
lady.
Swift, the singer lady, the queen of Kansas City. Yes.
All right. So share with us the story.
Okay, I had a really interesting.
By the way, and I
case.
looked at this. I looked at the notes beforehand. I thought, well, this is a good story.
Oh, good,
Yeah.
good. Yeah, it's interesting because I think it impacts more people than people realize. So I had a prospect come in a few years ago, and among other things, she had an old variable annuity, and this variable annuity had a guaranteed income benefit. So for folks listening, there are products out there that you can purchase. You stick a chunk of money in, and it's invested in the market. It goes up and down depending on how you invested it. But then you also can have a provision attached called a guaranteed income benefit. And it's a separate number. It goes up by some amount every year, regardless of what your contract value does. And then later in life, you can draw an income amount off of this guaranteed income benefit number. And the idea is that it's an upgrade from the old idea of annuitizing a contract. You don't really do that anymore. Nowadays, people turn on this income benefit, and it gives them this income for life, even if the contract value goes to zero. But if you pass away and there's anything left in the contract, it goes to your beneficiaries.
And every
So it sounds
contract's a
great.
little different, right?
It's
Even
yes.
an insurance company might have 20 different flavors of this. As the years go by,
Absolutely.
they're underwriter. It's insurance, right? So they underwrite it and think, there's a risk here that we didn't see, and there's this. People found this loophole that they're taking advantage of. We didn't calculate this.
That's right. So even if you have a contract that has the same name as your neighbor, but you took it out a year later, it could be
very
totally different.
That's exactly right.
So,
and by the way, full disclosure, like there were some products in the early 2000s that were just mispriced.
Oh my gosh, that was great.
Oh, so mispriced.
They had these 6% guaranteed minimum,
and you had full discretion on how to invest your dollars.
It was crazy.
And so we utilized them quite a bit then, but we don't so much anymore.
They didn't. They actually were mispriced.
Up.
Yeah, and the insurance
and then now they try to buy their way out of the contract.
They offer more money than their contracts are worth.
You get a letter in the mail. Hey, can we buy you out of this contract, please? We're losing money on you.
Okay, so continue with your.
Right. So with this particular situation, and by the way, the caveat to these products is they're very expensive, right? They can be upwards of 4% or more when you add up all the fees.
Yep.
And the catch is that fee is assessed on the guaranteed value, and then it's taken out of the contract value.
Which means that the contract is going to collapse quickly.
Exactly. So if you think about it, if your guaranteed value is twice as much as your contract value, that's not a 4% fee, it's an 8% fee. And that's really hard to overcome. So this prospect, who is now a client, she was just seeing her contract value go down each year. Her contract value was about $500,000. Her guarantee was $800,000.
And
wow,
she's thinking
Did she have it poorly invested in there, or how would that happen?
Oh yeah, it was a variable annuity, but she had it invested in conservative and fixed inside the annuity with whoever sold her this product.
Which is exactly the opposite, because if you have those guarantees, you go 100%.
You're buying insurance on your portfolio. Yes.
Yeah,
equity.
You go as far into equities as you possibly can, right? So this was just mismanaged from the start.
So she brings this to you and says, this is terrible. And you look at it and you say, wow, this is awesome.
Well, this is the interesting situation. She didn't need the income. She wanted the flexibility of having control of that money. So it's an IRA annuity. Her plan was, I'm just going to get rid of this thing, roll the money into my other IRA, and wash my hands of it.
And that's probably why she came in. Hey, Vicki, I want to get rid of this. Can I transfer this to you?
Correct.
And most advisors would say, yes, sign here.
Yep.
Transfer the account.
Open up a brokerage IRA with me. We'll move it over. I'll manage it. End of story.
Let's give him a little back slap on the way out.
Yeah. Win-win for everybody, right? Well, what I said was, okay, hang on. You've had this contract a long time. Give me the actual contract so I can read through it and just make sure we're not missing anything. So I got this old dusty tome of a contract, riveting reading, let me tell you. And inside that contract was one line that made all the difference. And that line was, withdrawals from the contract value decrease the guaranteed benefit dollar for dollar.
Not percentage-wise.
Not proportionally, which most contracts are.
Awesome. Unbelievable.
I know.
And there was no cap on how much you could take out?
No cap. So I call the annuity company with the client, verify that this is accurate. So what we do, instead of her taking $500,000 and just moving it to an IRA and calling it a day, we moved $475,000, so 95% of the contract, over to her IRA. So $475,000 goes to the IRA. Her benefit went down from $800,000 to $325,000.
Holy
She was
smokes.
65, so 5%. We turned on the income of 5% for life. So she got over $16,000 a year of income on top of getting to roll out $475,000.
My gosh.
Smokes.
Yes.
My gosh.
So if she lives another 30 years, that's almost $500,000 of extra income she would have not had.
Wow. Look, this is an extreme example.
This is an extreme example.
It is.
But I utilized something similar. This is an insurance company based out of Los Angeles. Yeah, it was dollar for dollar, not pro rata.
Yes.
And
some companies did it like that.
And life insurance. But so what happens when you don't have to worry
about it. It only works. It works for those people that invest, and then there's a downturn in the market quickly thereafter. Or like this person was just horribly invested. I mean, it was just
exactly. So she kind of had her cake and ate it too, because she got the contract value, most of it, and this income stream for the rest of her life.
I mean, life would have been better for her had it been properly allocated from day one. But
That's incredible.
Correct.
And I assume that she was happy with this decision.
Oh, very happy. Well, and the lesson is twofold. A, if you have one of these products, don't rely on the annuity company to see you through to what your best case scenario is. They are not sitting on your side of the desk. They're not your friend. You call them, they're just going to say, turn on the income or move it out. Those are your two options,
And
right?
Don't
So
and don't bring
you
it to
gotta
a
have
financial
advisor.
Yeah, well, don't bring it to
Yeah.
a financial advisor that just says yes.
that's going to sell annuities.
We're going to just transfer this. Right.
Right. You want to have a fiduciary. Please call Allworth. If you
there's
have
great-
an
but it-
old, crusty annuity that you don't know
Annuity
what to
or
do
life
with and
insurance
you don't
product.
understand, call us.
Or life insurance policy.
Because there's some of those old
Or
life
life
insurance
insurance
policies
policy.
doesn't make sense to get rid of either.
Yes.
Right. And they can be so complex, and you really got to dig into that contract
Yeah.
to understand the ins and outs.
That's I just did it with a client. He came to me, $2 million face value life insurance, and we lowered the face value down.
Universal life?
Universal life. We lowered. It was variable universal life. We lowered the face value down so to accumulate more, and then we named all his kids the beneficiary and moved his wife off so that for estate tax purposes.
And there's no premiums paid anymore?
No, none. And the thing yeah. But you see it all the time, right?
It's these old contracts.
Yeah.
Vicki, you see it all the time.
Normal people don't realize that there are these options out there that they can do with these products. And calling the annuity company, they're not going to tell you. So you have to have somebody who knows what they're talking about, knows what they're doing, who is sitting on your side of the desk to help you navigate.
And it's
that.
primarily these older contracts because the insurance companies got wise.
This
is a really
yeah.
stupid mistake on their end.
Yes. So.
Yeah.
And I remember years ago a product that we used. You were allowed to manage your funds by yourself. There was 30 different investment options.
That was crazy.
You can make trades every day. You can make the worst decisions possible. And the insurance company was on the hook. There was no
crazy.
restrictions whatsoever.
We used them back in the day. It didn't last long. That was the insurance companies.
But I remember, Vicki, we had a call with the chief actuary of this insurance company. I'm not going to say the name. Years ago, because we looked at this like this is too good to be true.
We said this can't happen. This is wrong.
And we got after the call, we looked at each other like they don't really understand this, do they?
Or they weren't interested in the long-term viability of the company. They understood it.
Yes.
Yeah, you got a point.
Yeah.
Right? They understood
Yeah,
it.
especially those contracts that came out in 2008 after the crash, and everyone was clamoring to get into
That's
a
right.
guaranteed annuity.
And then the insurance companies were battling for market share.
That's right. Yeah. So they were saying, yeah, we'll give you a guaranteed 7% compounding return on your guaranteed income benefit.
All right. Before we
Those are
let
the
you
days.
go, Vicki, can you tell us what your mostly I think I understand what you do, but what does the director of client experience actually do at Allworth? So we've got how many advisors now?
Oh, gosh. 150?
Okay.
Well,
Are you
on our way
guessing?
to
What's your
200
job? What's your title?
So what do you director of client experience, what do you do? Like if I asked you
Great question. I had to figure that out myself when I joined Allworth. What we focus on, what my team does, is we look at the client experience, because when you think about it nowadays, what really differentiates firms one from another is going to be how they treat their clients, right? That matters so much. So looking at that journey that the client takes as soon as they decide to become a client of Allworth and onward, my job is to make sure that experience is as amazing as it can possibly be.
and so
And
that
the experience, not just like we return your calls, experience just like what the scenario you just brought us through.
Yes.
like
So
the financial
not only
planning
does that-
software, tax, estate, that sort of thing?
Yes. So making sure that our advisors have all the tools they need to be able to be true fiduciaries and give the best advice, and making sure that we are up to snuff at all times on current policies, what's coming down the pike with markets and, taxes and wealth planning and estate planning and all of those components that are so integral to a financial plan. And then making sure that the client knows that we're on their side. We treat each of our clients like their family. I mean, I know that our financial planners here are really top notch. They are cream of the crop,
And
which is why a lot of high net worth clients, a lot of high net worth people are seeking Allworth out specifically.
Thank you.
Thanks for the commercial,
That
Vicky.
is a great commercial. Vicky, as always, thank you for being on the show, and thank you for being part of the Allworth team. You are a valued, unappreciated coworker.
Yes, thank you so much. I appreciate you guys.
Yeah. By the way, on the topic, that's why a lot of high net worth people seek Allworth out. But let you know about our webinar that we've got coming up. On the topic of our webinar is top investment moves for high net worth planning. So it's really designed for people with more than $1 million saved in investable assets. Not that we don't value all individuals, just there's some different things that as your net worth goes up that you need to start thinking about. So during this webinar, we're going to talk about some Roth conversions and how pros and cons of those and how to think about that. Look at unwinding concentrated stock positions. So perhaps you retired from an employer where you've got big chunk in one particular company. How do you go about a strategy without incurring big taxes? How to utilize some excess cash and much more. So Allison Scoggin, one of our great advisors, certified financial planner, and is going to be doing the webinar. It's Wednesday, January 22nd at noon Pacific. Thursday, January 23rd at noon Pacific. Saturday, January 25th at 9 a.m. Pacific. So the 22nd, 23rd, and 25th. To learn more and to register, go to allworthfinancial.com/workshops.
Before we go, I mentioned these ETFs, and we're not going to have time to talk about it.
Yes, we are.
Oh, okay, we'll talk about it. So the U.S.-based electronic exchange-traded funds, right? Exchange-traded funds, ETFs, surpassed $1 trillion in inflows.
Yeah, I saw that last year, right?
Yeah, that means new money coming in, $1 trillion, right? And so now they make so many flavors of them. And this one,
because it's the modern day mutual fund.
That's right. And there's some tax strategies.
And by the way, if you own an old mutual fund, particularly if it's outside of a retirement account, you're probably best just keep it in that old mutual fund because there's no sense incurring.
But not reinvesting dividends in cap.
No.
Yeah, many people actually have it automatically triggered to reinvest dividends.
If it's outside of a retirement account, I would not do that.
Yeah, that is wrong. But so
most of the time,
my favorite was this one called the Simplified Enhanced Income ETF, which should just ring all kinds of bells.
Simplified
Enhanced Income ETF. Right?
Sounds like people sitting around in the conference room in the afternoon coming up with a name.
We're going to call it the
Simplified and Enhanced.
It trades under the ticker HIGH, HIGH. Good for them for getting that ticker. I would have thought that was taken. So it is a simplified enhanced income. So basically what this thing is supposed to do is kind of act like a treasury.
You know, the challenge, here's the problem with this, right? I don't even know what the product is yet. Right? You're going to tell us.
Yeah.
But here's why why you mentioned when the ducks quack, feed them, right?
Exactly.
Because sometimes you hear callers on this program. Someone's going to retirement. They're looking for a high income strategy because they need income in retirement. They've been investing in their 401k for years, but now it's time for income. They go doing some research. They start Googling around and they bump up in this. Even the ticker symbol's high.
Yeah. How could you go wrong with a simplified enhanced income portfolio?
It's simplified, just what you were hoping for. You don't want a complex investment strategy. It's enhanced and simple.
You're like the marketing team, A+. A+ on the marketing team over there for their simplified and enhanced. So what it's supposed to do is kind of act as a treasury, but a little bit better since the symbol is high. So in addition to buying short-term paper, HIGH buys and sells calls and puts and options to generate income. Oftentimes they use this as kind of to make more fluid the volatility. They even traded options on MicroStrategy.
MicroStrategy?
They were trading
By
options.
the way, if you're not familiar with MicroStrategy, they're their own
leveraged
strategy.
Bitcoin.
It's leveraged Bitcoin. They own Bitcoin. That's all they do.
Yes.
And it's worth about double what the underlying assets are.
Which is, by the way, I have a friend that has been doing put options on it, thinking it's going to fall.
No. A bull market can last much longer than your liquid.
I said to him, it makes sense. And at
It
one
could be
point in
8
time,
years.
I said, at one point in time, you will be right.
I had put options on Countrywide.
Oh, I remember that. I lost money on that.
You did too.
Yes. I was convinced they were going to go out of business.
They
and
did.
They did. Just not
years
in time.
long.
Not in time.
Not in time.
So they traded strategies. They did put options. They tried options on this thing, right? And this is in an income fund. This is in an income fund that is doing puts and calls.
And you read, and it says the majority of their is in investment grade securities.
Yes.
So how did it do?
Their year, they ended up with a return of 1.5%. And the thing that they were trying to do a little bit better from would be like the Bloomberg Spider, BIL bill, right, which is a 1 to 3 month treasury, return 5.2.
So treasuries were 5%.
And this thing was supposed to be a little bit better than treasuries, and the return for 2024 was
How much assets did that?
1.5.
No,
it actually
article say
didn't.
that?
It didn't say. But the thing that as the article goes on and continues,
Just because
to talk
something's an
about
ETF doesn't mean it's a good investment.
is that they're rolling out these ETFs like daily, new ETFs.
Well, because it used to be when they first came out, they were all passive. They
That's
were all
right.
indexed.
That's right.
They're not any longer.
Well, because technology allows you to price all
That's
day
right.
long, right? And that's really what an ETF did for the mutual fund industry is it allowed you to buy somewhere in the middle of the day rather than it open or close. But it just reminded me, as I said earlier, about when the ducks quack, feed them. And look, these firms, they're designed to sell you stuff, right? They want clients. We want clients.
So, I mean, Victoria Bogner,
we want clients. I mean, Victoria said
she talked about fiduciary. She mentioned that word a few times. A product manufacturer's not a fiduciary.
that's right. They don't care.
They may care,
Okay, fair enough.
but their job is not to do what's in your best interest.
Well, look and the products are not either good or bad.
It depends how they're used.
It's how they're used, right?
That one might not be too great.
I'm going to go with that. I'm going to go with
When
that.
you buy put options on, I mean, you're taking
In MicroStrategies in an income fund, like if I came to you and said, "Let's create an income fund." Oh, by the way, we're going to do options on MicroStrategies, you'd
which is
say,
essentially on crypto.
What you're trying to do is enhance.
We're
going to
use crypto to enhance your return.
Well, not
on
only are we
interest.
using
We're
a
betting against-
financial instrument to enhance the return, we're going to do it a company that's highly leveraged against a speculative asset to begin with. You're like, okay, where's when you go across this tightrope, let's get rid of the net.
All right. Hey, as we wrap up this program, if you haven't given us a review or a rating, please do. So if you're listening to on your Apple thing or Spotify, where do you listen to your podcasts?
Spotify.
I do Spotify as well. But I think more people. I looked at we have a lot of ratings on Apple, but not as many on. I don't care where you give us a review.
Wait, let's stop for a second. Have you read any of the
No,
reviews?
I don't read them.
You've never read reviews of the show.
I don't know. Not that I recall.
Okay.
I don't spend any time. I have zero interest. I do look at the stars. If we had if it was a bunch of bad ratings, I'd want to know why. But it's good. I think we're 4.9 or something. I don't know. You can't.
It's higher
please
than
everybody.
my Uber rating. Do you ever check your Uber rating?
Let me finish this. So
Okay.
before we talk about yes, I do because I don't want to be a jerk.
Okay.
I want to be perceived, and we Uber quite a bit because we travel for work, and it's actually a
Yeah.
very efficient way to get around town instead of going to rent a
I'm going to
car.
tell a story about getting in the wrong Uber.
Okay, well, real quick though. So, give us a rating.
Yeah, there we go.
I don't even know what I was talking about.
I got in an Uber, and I'm almost to the destination, and then the guy realizes, and I realize,
You're kidding.
no, and
Don't you check the license plate?
I didn't that time.
In some states, you're not required to have a front license plate. And I'm thinking, if you're an Uber driver, you should have a front license plate because you're sitting there, and
That's
here
right.
comes this car, and there's no license plate.
It was like, and the difference in the car was that they were both Toyotas on the thing, and I'm like, yeah, it was dark out, and I get in the car, and we're almost to the destination. We both realize and the guy, she's like, I'm turning around. I said, no, we're less than 3 minutes away. You're not bringing me back 15 minutes. He said, well, you're in the wrong Uber. I said, I know I am, and it's bad for you too, and it's bad for me. But it makes no sense for you to turn around. And he said, how am I going to get paid? And I said, I will pay you.
Here's some cash.
Here's some cash. But we're not turning around now. And now I check.
That's interesting. Like, what if he would insisted on you turning around? I imagine he has to let a passenger out, or she has to let a passenger out if you went out of the car.
I was not getting out of that car. I mean, where I would have, it's a business.
You couldn't force the person to go where you wanted to go.
Okay. Fair enough. I would have had to go back.
You throw a little cash and they go where you wanted to go. That is their business.
Yeah, that's what he's there for.
A couple $, are going to drive you
I
there.
said, I'll take care of you. And he said, how much? I'm like, good for
him.
you.
Yeah. All right. We'll see you guys again next week. This has been Scott Hansen, Pat McLean of Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.